We bring you news and analysis every day on the Bloomberg Surveillance Podcast. But now you can get the latest news on demand whenever you want. Subscribe to Bloomberg News Now to get the latest headlines at the click of a button. Get informed on your schedule. You can listen and subscribe to Bloomberg News Now on the Bloomberg Business app, Bloomberg.com, plus Apple, Spotify, and anywhere else you get your podcasts. Search Bloomberg News Now and subscribe today. This is the Bloomberg Surveillance Podcast. I'm Tom Keene, along with Jon Ferro and Lisa Abramowicz. Join us each day for insight from the best in economics, geopolitics, finance, and investment. Subscribe to Bloomberg Surveillance on Demand on Apple, Spotify, and anywhere you get your podcasts. And always on Bloomberg.com, the Bloomberg Terminal, and the Bloomberg Business app.
Laurie Calvasina joins us now, Head of US Equity Strategy at RBC Capital Markets. Laurie, what if I have you with us on the programme to kick off this trading week? There's a line in your recent note, we aren't convinced this is the end of the current period of equity market weakness. Laurie, why is that?
Well, I think that basically what we did with the government shutdown is we took one of a number of different issues that have been weighing on market short term off the table. And we only took it off the table for, maybe a month and a half or so. We'll see how long it lasts. But I think, we always look at these kind of episodes in markets and say, where was sentiment? And I don't think sentiment got bad enough last week to serve as any kind of big springboard. So we were looking at some of the commentary that was coming out over the weekend saying, it's time to buy, we're in the clear. And so, well, this thing has just been kicked down the road. There's still a lot of other stuff we're going through. And sentiment just never got that bad. We saw concern come back last week. We didn't see fear. And if you look at the AAII survey, net bulls got down to about minus 13% on the weekly data point, but the 4-week data point, the 4-week average was about flat. You contrast that with back around the SVB period, we were at minus 20% or worse for 4 weeks in a row. So we're just not anywhere near the same kind of point where we can say, okay, it's so bad, we got to go higher from here.
Laurie, once again, small caps disappoint. I have a chart I keep of the NASDAQ 100, granted it's 7 or 8 super stocks. Maybe they're Dow stocks, but we don't want to admit it. And the Russell 2000, and it's a chart of failure. What should these companies do if they can't get value from the market? Should they go private? Should they merge? Should the zombies go away?
Well, I think there's always going to be, sort of that zombie element in the Russell 2000. I don't think they're going to, disappear anytime soon. I do think that we have to keep an eye out to see whether or not there's more M&A activity that comes up, particularly in an area, say, like the industrial space, where we often hear from small cap portfolio managers that quality of management and quality of businesses is quite high. So I think that's one thing that we can look at. I think, frankly, small caps just have a problem at this point in time after that last Fed meeting, because while I do think 2024 cuts are still on the horizon, that's still the call of our rate strategy team. I think there's starting to be some doubts about how many cuts, about when, and that was really the catalyst I think that small caps needed to really get going, and it seems like it's been damaged. I think we're also just in an air pocket of economic uncertainty right now, and small caps I think also needed to see incremental enthusiasm about the 2024 economy emerge, and instead we've gotten the return of uncertainty in here.
Laurie, a couple of months ago you came on and you expressed caution but said you were not bearish, that you did see equities muddling through. Am I hearing that you are more bearish now after seeing where bond markets are, how high yields are, the fact that that yield cuts, that rate cuts are not being priced into the market, maybe shouldn't be priced into the market for next year?
No, I think, our head is still really where it was at the beginning of August, that we've got some short-term issues that we've got to work through. We've had a tremendous run in the market this year. I would say, though, there's definitely a camp of strategists out there, right, who are very much in the doom and gloom camp for next year. And I wouldn't put me in that camp by any stretch. I do, sort of subscribe to what you guys were alluding to as the Neil Duda view earlier of kind of the resiliency of the consumer. I just think we're not going to get a lot of information about that in the here and now. Companies seem to have planned up, and they're frankly not saying anything that's all that useful, whether you're looking at conferences or the last round of earnings reports. And I think that's a problem when you've had the year like we've had. Doubts are starting to creep and about the economy again, and we're not getting a lot of stars to navigate by at this point in time.
I think the interesting point about this moment, Laurie, is that unlike through the rest of this year, consumer discretionary is starting to crack. The equity market is starting to show some real weakness there. The story of the year has been consumer discretionary has really performed quite strongly. What do you take away from the weakness we're seeing in the equity market for discretionary recently, Laurie? Whether you see that as a buying opportunity, if we discounted enough going into Q4?
I think it depends on what part of consumer discretionary you're talking about. We talked a little bit about small cap earlier. Small cap consumer discretionary stocks, which do tend to, sort of migrate more to the lower end. They're more domestically focused. They priced in a recession last year. The big cap S&P 500 consumer discretionary stocks did not. And while valuations don't look terrible right now, they haven't been looking cheap at any point in our model over the last year and a half. So we think the risk reward there is not fantastic. And then, we talked a little bit about higher bond yields. That's really, I think, probably one of the biggest problems we're dealing with. And the problem is that it traditionally, if you look in a post-GFC world, the sectors that do most poorly when bond yields are rising are things like consumer discretionary, communication services, kind of those growthier parts of the market. So you've got a sector that did never get cheap enough, economic angst is rising, and you've got this bond yield negative catalyst hitting all of, kind of hitting it precisely the wrong time.
Laurie, James Dimon is going to get all the press today. He's going to do chit chat with Emily Chang in London. Great. It's all going to be, the usual big bank stuff. The BKX chart is a train wreck. Are the banks the mother of all value traps here?
It's interesting. Financials should be outperforming in a higher bond yield environment. They're not doing that right now, not to the extent that they should be anyway. And we're seeing, energy has really kind of sucked, some of the benefit that the other parts of the value trade would see. I think it depends on your time horizon. I do like financials in the S&P. We're overweight. We have said we like energy better. You are seeing a nice revisions recovery if you look at the bank space in particular, but we haven't quite crossed over into positive revision territory. Things have just been getting less negative. I do often find that when you see earnings revisions turning, but they're not quite in positive territory yet, you still have a lot of doubters in the trade, and that's often a good opportunity to come in. I think there's money to be made here long term, but I do think you have to have a stronger stomach, and there frankly may be other parts of the value trade that just don't have as much hair on them.
Hey, Laurie, thank you. Good luck for the rest of this week. Laurie Calvasina there of RBC Capital Markets.
Joining us on Jordan Rochester, G10 FX Strategist at Nomura. What I see, Jordan, this morning that is absolutely distinct is finally Swiss franc gives way to stronger Swiss franc. It's ever so slight, but that's a distinctive tea leaf. Link euro trajectory with the symbolism of a stronger Swiss franc to come.
Indeed, Tom. I think last week's weakness in Swiss franc was a lot to do with month end as well. A lot of moves last week were to do with that month end flow because of the equity sell-off that we had. But when it comes to the sort of view on Swiss and Stocky and all those sort of local euro area currencies, Swiss is one of those currencies where in a global slowdown, it tends to strengthen. It's still got a banking repatriation flow as well. So if you think the euro area is going into a recession, which we do, that is usually to Swiss franc's benefit. You've still got a central bank that is also intervening in the FX market as well. 11 billion euros per month of FX intervention to strengthen their currency. So even though we think the S&B is done with rate hikes, because of the impending global slowdown, the potential for recession risks pretty much in Europe and the US, it's very hard to be selling the Swiss franc.
Okay, sell Swiss franc, I'll go with that, but then I got the euro. What is the appropriate pair to play weaker euro?
Well, we're looking at it this morning. I mean, the view for us is euro dollar and euro CAD. I think euro dollar towards 102 towards parity is very possible as long as oil prices don't find a way to collapse. In the previous guest you had on, Kit Juice, he was talking about US yields rising higher. Well, US rates suggest that euro dollar should be at 101 to 103 already. And if oil gets to $100 a barrel to $110 a barrel, it's very easy for the euro area to see their currency weaker because they are an energy importer. The problem for all of us this year in euro, as the chart shows you, it's been a zigzag, up, down, up, down, up, down. And this looks to be finally an exit of that range-bound price action. This looks to me more like a trend now. It's a bit of deja vu to last year. Last year, euro broke through parity thanks to Vladimir Putin, natural gas supplies being squeezed. This year, it's more thanks to what's going on in the Middle East with the lack of oil supply. And that's going to help the euro get towards those sort of figures. The main risk is if the US data starts to come in soft and US yields stop climbing. But I think we've had a bit of good luck in that respect for this week at least. US government shutdown's been avoided, which means that we're going to get non-farm payrolls, we're going to get the JOLTS data, and crucially, we're not going to get all those government workers laid off. It was going to be really difficult for the market to buy the dollar with initial claims, jobless claims, spiking higher on Thursday. Well, that shouldn't happen now, thanks to that government shutdown being avoided.
Jordan, we've got a natural bias here to ask questions about the US dollar, US rates, Federal Reserve, the US economy. You touched on the international story. Can you help us understand how important that is? Not just what's happening with the Middle East and crude, but also what's happened or hasn't happened over in China.
Absolutely. Well, the situation in China has been that for the first half of this year, most economists were quite disappointed with the growth data. We've had a more bearish outlook on China than most when it comes to our GDP forecast. But what's happened over the summer is that China has done little bits of policy here and there, and it's kind of built up to a much more mixed view in the market on China, which is China slowing down or is it bouncing back? And the property measures, such as cutting mortgage rates for first-time buyers, is a significant one because most of the Chinese property market is first-time buyers. Well, that's going to lead to some of the Chinese data looking healthier over the short term. But for us, the long term is that China's trade balance, China's current account, those flows are looking pretty weak, especially with the tourism outflows, which are going to continue to pick up. So from a flow perspective, we're not seeing the inflows into China bonds like we saw from foreign investors either. Altogether, weaker outlook for China, a bit messy in the short term for data surprises because of all of these sort of measures that were announced. But the big picture is a slowdown and a weaker renminbi for us.
Does that make it more difficult to make a call for next year that goes beyond 110?
Well, the difficulty with the euro-dollar view is that when the Fed cuts rates, when you get liquidity, it leads to dollar weakness. Now, we have the view that the Fed could even cut rates as soon as March because of a recession call that the US economics team at Nomura have. That starts in Q4, by the way. But if they're wrong, if we get an actual soft landing for the next few months, because soft landings can last a few months before it turns into a hard landing. If we have all the data in the US pretty healthy in Q4, it pushes those Fed cuts out. So that 110 call is based on a Q1 story next year, really, where the market quickly shifts to saying, yep, Fed cuts are coming in the next few meetings. At the moment, we're in the higher for longer phase. That's why the dollar's not selling off here.
Jordan, one reason why I love your research is because you always put the sort of conviction level that you have on each trade. Can you talk about how difficult it is to have conviction at a moment where you're dealing with so many variables? We're tracking the weather again. We're tracking, different congestion pricing and congestion emissions over in China to understand the recovery. I mean, how do you have conviction in a market like this?
You have to look at the local stories, I think. So you have the broad dollar view, which we've got a pretty high conviction on, 3 to 4 out of 5, I would say, for the long dollar view. Then the local story, and what helps me, Lisa, is positioning. So just a few weeks ago, maybe let's go back 4 weeks ago, you would have had guests on here saying the Bank of England could raise rates maybe to 7%. And because of 1 week services CPI and one Bank of England meeting and a weak labour report as well, it's quickly shifted to the Bank of England's done. And because of that shift in narrative, you've got a lot of stale positioning out there. So I think in sterling, there's still a long sterling position amongst some investors that needs to be unwound. We've gone through a lot of that already, but I think there's more to go. So that helps me have a 4 out of 5 on short cable, for example. Or then you have to look at the other factors in Asia and elsewhere and think, where is there less positioning? I think that's where you have lower conviction. So if there's less positioning, less of a positioning squeeze, there's not much of a trade to do. But short cable, short euro, I think there's still some stale longs out there that need to be unwound.
Jordan, this is a pretty toxic recipe for the Bank of England and for the European Central Bank, right, with inflation?
Well, inflation's coming down. The main thing is, does it not fall to 2%? And that's what the central banks are really worried about. I personally look at all these charts that help us forecast inflation, and it looks like it's going even below 2% on some of them. So PPI, which is the manufacturing inflation in the UK and Europe, it's pretty awful. I think in Norway, it's minus 35% year on year. So you get these extremes in manufacturing that will push the headline down eventually. So I think, look, we could be looking at CPI falling much closer to 2% than central banks think. And then, Lisa, Lisa, we'll be looking at global recession risks in the early part of next year. And a lot of these central banks that are worried about inflation today will be very worried about growth and employment tomorrow. We've already got signs in the UK labour data, the Swedish labour data. There's layoffs happening. And when we get to the year end, I think a lot of central banks will be changing their focus on inflation was high today and focusing more on the fact that it's going to be quite low tomorrow. The main risk to that, of course, is oil and the supply side. So in the US, these UAW strikes are boosting car prices. And as we know, the oil market's moving headline inflation higher as well. If we have another rise in oil to 110 per barrel, then inflation will be, the central banks will be in a stagflationary mode, and the markets won't like it. FX will be selling those sort of currencies like the pound, like the Swedish krona, because that's what the sort of mix we had in 2022. So we could be going back to a 22 style FX market reaction, which was massive dollar strength.
Well, 20 seconds for you, Jordan. You can have it. When was the last time Villa scored 6 goals?
I can't remember. That's a good stat, but it's bloody good, isn't it?
It's bloody good, Tom. Do you hear that? Jordan Rochester. Jordan's words. Not
I practiced all weekend proper.
Jordan Rochester and Nomura. Jordan, thank you.
It was proper. Never with a cork in his mouth is Michael Darda, chief economist, macro strategist, dog keeper for Roth MKM, just back from Japan, which is always a good and wonderful thing. Michael Darda, in your political economics, what did you learn in Tokyo and Kyoto?
Well, Tom, we were there on pleasure, not business. Incredibly beautiful cities, majestic, if you're talking about Kyoto. And for people that have never experienced it, I mean, in Tokyo, imagine a city 3 times the size of New York City with essentially no litter, no crime, and almost no one even disobeying traffic lights. I mean, it's quite a trip. You have to experience it firsthand really to believe it, frankly.
They are imputing inflation into their system. Some would say they're inventing an inflation. Do you see any historical analog that any country can manage inflation higher successfully?
Well, sure, Tom, if you believe in the power of the central bank, and that's essentially what's happening. The discussion earlier, Lisa really hit it on the head. The problem for the BOJ is that they can't hit 2 targets with 1 arrow. So if you're going to effectively peg an interest rate, you can't at the same time peg the currency or even, control the price level perfectly. So, what's happening is they've got to adjust the rate pegs based on macroeconomic conditions. It's different in the sense that typically central banks, will target the short policy rate. In Japan, because of the zero lower bound situation, they're targeting a long-term interest rate, but the same basic concept applies.
Mike, if we do get some sort of abandonment of yield curve control, or the Bank of Japan losing the plot, losing control, losing the narrative when it comes to controlling bond yields and controlling the depreciation of the yen, how much does that accelerate the move up in U.S. yields that we've seen as we see just yields globally rise and maybe some of those buyers from over in Japan step away from the U.S. market?
Yeah, it's an interesting situation. I mean, if you look at what's happened in the U.S. bond market, we've had a huge real rate shock. So this isn't really an inflation expectation story. So you do have, movement in global yields on the back of, central banks trying to persist in a tighter policy regime. But it's really driven by real interest rates. Inflation expectations in the U.S. have really barely budged. So crude oil prices are spiking higher. Copper's rolling over, and Fed rate hiking expectations, or if you look at, let's say, the 36-month Fed funds futures yield, it's moved up 150 basis points since the spring of this year. So that really accounts for the entirety, more than the entirety of the rise in the 10-year yield. So it's a higher for longer trade based on the back of perceived economic resilience in the states, and the fact that the Fed's reaction function is to make sure that growth slows below trend. So if it looks like that's not happening, then they're going to persist for a longer period of time.
Mike, there are a lot of questions over the weekend about why something hasn't broken, given how quickly rates have risen, given how quickly benchmark yields have risen. Do you see any evidence, either in the economy or in the markets that you track, that shows that something is breaking?
Well, I think The reason something hasn't broken yet is the strength of the cyclical upswing that we've had coming out of the COVID shock has been much more robust than what we've seen historically, especially relative to the last cycle. So with that, you're going to have a higher neutral interest rate. And with a higher neutral interest rate, it'll simply take longer before things start breaking. So you can have more central bank tightening before things fall apart. There also may have been some temporary factors that have held things up this year. There's been a very strange explosion in the fiscal deficit at a time of full employment. That is probably also feeding into the higher for longer strategy on the part of the Fed. So those factors matter, but the critical element here is, nominal growth is slowing. Nominal GDP growth is slowing on the back of tighter Fed policy. Gross domestic income in nominal terms, even if you adjust for Fed losses, has essentially decelerated to trend or below trend growth. Here you have the Fed, with policy rates up at 5.25 to 5.5, and they may move up further. So I think in terms of something breaking, that could still be in front of us. There's a perception that we've successfully soft landed, but those kinds of discussions are pretty common prior to business cycle peaks and recessions. So we're not quite out of the woods just yet.
Michael, first day of Q4 primer. What is the signal of disinversion? If 2-10 spread is 100 pre and misra basis points and we reverse and we start to disinvert towards normal, what is the signal of that?
Well, you don't get meaningful and sustained disinversions without the front end of the yield curve coming down, which would happen in a slower growth recession scenario with the Fed cutting interest rates. It certainly would be possible, at least theoretically, for the long end to just keep rising in the curve to disinvert. But that's actually pretty unusual historically. The last time we saw anything even close to that was actually 2007. And within a few months, we were actually in one of the longest, deepest recessions in history. So, this inverted yield curve structure backdrop that we have, I think, is a real warning sign in terms of the sustainability of the business cycle. And, I think a bit of cold water in terms of getting too excited about any kind of sustained growth acceleration.
Mike, some real confusion for me, at least at the moment. I hear lots of confidence to why yields can go lower, but I feel that I hear little conviction as to why they're higher. Mike, I don't know how you can make the call for the former without an understanding of the latter. Mike, why are yields up so much at the long end? How much of this is just about budget deficits in Washington?
Yeah, I think a combination of forces, John. Obviously, the economy has been more resilient than anticipated this year. And you do have this strange fiscal policy environment where the fiscal deficits exploded to levels really never seen outside of wartime when you're at full employment. And so the Fed's higher for longer strategy has been self-actualized by the bond market. We can see the move up in real yields is going basically step for step with that 36-month Fed Fund futures implied yield. So that's the higher for longer trade. But that can also be unwound. This has happened over the course of this year, over the last 6 months, really. And with softer data going forward, that trade can be unwound. So I think we know why it's happening. The question is, what is the forecast going forward, and will that forecast be accurate?
Mike, thanks for the insight, buddy. As always, Mike Darda there of Roth MKM on this bond market.
Let us dive in right now to what you and I witnessed this weekend. He witnessed it as well. The congressman from Arkansas, French Hill, he's been such a good friend of the show and trying to give us perspective on the history we're witnessing. French Hill, I really take issue with people that say this has never happened before. It's an outrage. Baloney, my reading of history back to Alien Sedition Act is this is frequent. Like Joe Cannon, 1910 is an absolute parallel here. From those analogs of the past, Alien Sedition, Joe Cannon, 1910, what is the outcome for the Speaker of the House you support?
Well, Tom, it's great to be with you. Always good to be on the program. Look, I think Kevin McCarthy should Congressman Matt Gaetz bring a motion to vacate the chair to the House floor. There'll be a motion made to table that motion. And I think Kevin McCarthy survives. Look, Kevin McCarthy has over 200 solid supporters in the Republican Party. You witnessed that in January when it took 15 rounds for him to be elected Speaker of the House. And on your historic point, that hadn't happened that many times since 1923, exactly 100 years before. And I think it was 9 rounds then. So these items have historic precedent, as you point out. Kevin McCarthy has the support of his conference. He's doing a good job as Speaker of the House, bringing to the House floor important measures. He negotiated single-handedly, virtually, a good debt ceiling deal that lowers spending 2024 over 2023 and has some other important economic reforms. And so that's why I think his colleagues will sustain him as Speaker of the House.
You're entrenched in Arkansas. Fine. There are Republicans up north who are not entrenched. And their outrage this weekend seemed to be tangible. Are those Republicans in the North at risk because of the foolishness of the weekend?
It's such an important point. We have our majority, Tom, our very narrow majority, where we can only lose 4 or 5 votes on the House floor. Because we have won districts in which President Biden won. So in New York and in California particularly, we have House Republicans that won successfully with outstanding campaigns in 2022, but they might be in a Biden district +3 or a Biden district +13. And so they are really hurt in their districts if it looks like we're not governing and not honoring our commitments on spending and regulatory policy. In other words, they're conservatives and they're advocating at home for solid conservative Republican values, but they want to deliver it in a way that makes sense. And this kind of back and forth does, I think, put them at risk.
Congressman, does it help them if you combine the Ukraine aid effort with the aid effort for the southern border?
Jonathan, I think you'll find that we will move a Ukraine bill in the coming days and that we're building a consensus around what that should look like, including oversight of the administration's strategy in Ukraine to win and win promptly. But look, overwhelmingly, and you've seen it in vote after vote, there's a majority of members of Congress that support Ukraine funding. They want to make sure that other countries are doing their part. They want to make sure that that money is transparent, and they want to make sure that the Biden administration is encouraging a strategy in Ukraine that can win and win promptly. There's definitely fatigue after the stalemate of this summer along the front lines of Ukraine.
Why is it important to combine that with the border security issue, which essentially is what Speaker McCarthy communicated over the weekend?
Well, this is an important political point domestically, Jonathan. People are stunned by the incompetence of the Biden administration to secure the border. Over 6 million people have crossed the border. Over 151 people on the terror watch list have crossed the border. Hundreds of pounds of fentanyl that can kill the Americans many times over. And 200,000 people a month are coming across the border, setting a record up 25% from last year. So I believe, and I hear this from my constituents, the governor of New York has even called out the National Guard on this issue. So every state's a border state. We think the most pressing domestic problem, besides getting spending under control from the pandemic, is the border and border security. And that's why I think Speaker McCarthy set that out. Let's find a compromise and do something about border security, honor a commitment. We've passed that bill across the House floor only with Republican votes. We call it H.R. 2. And we'd like to see if we can get Democrats in support in the Senate for border security. There is a strong majority to support Ukraine under the terms that I just outlined. So let's do both. Let's have two wins by working together.
Whether it's the border, whether it's Ukraine, whether it's the budget, whether it's getting Kevin McCarthy to remain a speaker, Congressman, are you finding sort of a greater ally in centrist Democrats right now than the far right of the Republican Party?
Well, inside the Republican Party, we have some goals. We want to secure the border. We want spending below the pre-pandemic levels to the best that we can, considering the wins that we locked in the debt ceiling deal between President Biden and Speaker McCarthy. Those are shared priorities inside the Republican conference. We're still educating, in my view, our members on what is the best course forward for Ukraine. I admit there's a party split there, and I'm disappointed about it. I'm a strong supporter of kicking Putin out of Russia. It's an outrage that he's there. And there are many reasons why Putin was green-lighted to invade Ukraine that date back to the Obama administration. But where we are is where we are, and we're doing that work, I think, to find consensus on how to move forward on Ukraine.
Congressman, I guess that what I'm trying to say is if Speaker McCarthy remains Speaker, there are going to be some Democrats that basically give a pass to it. Is there increasingly a centrist coalition that's going to have a greater influence going forward?
I think it could be. Lisa, you saw that in the run-up on trying to find a solution in this most recent conflict on the end-of-year spending, where you had centrist Democrats work with Republicans to try to find a way forward for a continuing resolution. So you may see that continue, and if so, that may be in the best interest of the American people if centrist Democrats come to the Republican side and work with us on things to cut spending, secure the border, and properly fund assistance to Ukraine.
Congressman, I've known you long enough to know that these issues frustrate you. Shutdown debates, debt ceiling issues. Do you think your colleagues in Washington understand that they're losing the privilege to act recklessly based on what's developing in the Treasury market?
Jonathan, you are so right. I have made that point repeatedly over the last month. Looking at that 10-year this morning at over 4.6 gets my attention. Moody's comments get my attention. And one thing that we had, and you'll all appreciate this, in the Republican continuing resolution that failed on Saturday, all the Democrats voted against it, and 31 Republicans voted against it. Very disappointing. Very disappointing. It would have secured the border, cut spending by 8% for 4 weeks. Was a debt commission, Jonathan. And that's exactly what we need, is a bipartisan Alan Greenspan type approach dating back to 1983, where we solved Social Security solvency at the time and produced a 40-year positive outcome for that very, very important program for our seniors. That's the kind of approach we need to take on finding a bipartisan solution to long-term fiscal concern on that 2/3 of spending that the U.S. Congress does not debate.
We got to talk more about it. We can do it. Maybe in Alabama, Razorbacks Bama, October 14th. Congressman, thank you. Congressman French Hill of Arkansas.
Subscribe to the Bloomberg Surveillance Podcast on Apple, Spotify, and anywhere else you get your podcasts. Listen live every weekday starting at 7 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can watch us live on Bloomberg Television and always on the Bloomberg Terminal. Thanks for listening. I'm Tom Keene, and this is Bloomberg.